What a week that was, really, for anybody who's exposed in any way. What have you learned from this week about commodities, about Glencore, or about the way that stock markets can perform?
I think it's still extraordinary that a FTSE 100 company can have a week like this, down 30% on Monday, get it all back by the end of Thursday. Just extraordinary, and I think people are still trying to digest it and work out exactly what happened.
Do you think that, does this have a lot to do with market positioning around the weekend? Because looking at some great reporting we've done on this subject, there doesn't seem to have been a great deal of news flow around the weekend. There was a gloomy report from Investec, but not a great deal of new news. And yet we opened on Monday in such weak form. And was this just to do with a lot of the shorting that was going on in the markets already? We
don't know exactly, but everyone suspects that, yes, there was a lot of short positions in the market, and some hedge funds we know have taken prominent positions short on the stock. And that seems to coalesce around that report and produce this extraordinary dive that we saw on Monday morning. Yeah, so we find a business at the epicentre of a panic, really, don't we, in markets. Does that constitute a Lehman moment? How do we define a Lehman moment these days? I guess it has to have more systemic impact than we've seen as yet. I think that's right. And, you know, Glencore have mounted a pretty strong defence in the last few days. They've been really active talking to journalists like us, their lenders, their shareholders about why the company actually has a lot of liquidity and can, you know, plenty of strength to survive in the short term. And, you know, I think that's been effective. And, you know, after all, your stock price only moved 0.6% yesterday.
What a relief. Yeah. Well, yeah, I mean, after the August that we had, then anything that stays the same for a few weeks is quite a relief, isn't it? I mean, Lena, on a broader perspective, you know, obviously the commodities story and the emerging market story is all linked in here. And I was looking with interest at a report we've got out that says that, well, according to data from the Institute for International Finance, emerging markets are set for their first annual net outflows this year in some 27 years. So we haven't seen money leaving faster than it's come into emerging markets in 27 years. This is quite some turnaround. No wonder we're seeing big gyrations in various asset classes.
Absolutely. I mean, you know, between this and the fact that the markets are still expecting that the Fed will move towards tightening rather than easing, so the direction of travel in the next 12 months, I think the markets are very much discounting peak liquidity. And peak liquidity means peak global excess returns for leveraged assets, such as commodity markets. And, of course, that means the trough of global market volatility. So we are going to get more global market volatility now. We have just come out of 7 years of extraordinary liquidity, and we're still very much in the midst of currency wars. Central banks, excess liquidity in the markets probably creating more distortion than reflation at this point, and that means that we have an excessive leverage, and that as that gets unwound, of course, we're going to see more underlying asset volatility. But one thing that actually in the conversation that just happened came to mind is it is extraordinary, I think, in my career, and I've been a chief financial economist for a better part of over a decade, to see this kind of a disconnect between commodity markets, equity markets and fixed income markets for so long. And I think what we have seen in the last 3 months is probably more of a reconnect. In other words, when you look at Treasury and Bund futures at basically record highs, and you think, there's an excessive tail risk to the global economy being priced into those markets. When you look at exchange rate volatility in emerging markets this year, there has been that sort of a signal of peak liquidity and outflows leaving. At the end of the day, in the world that we live in today, markets are a lot more sensitive to the price, the cost of capital, the price of leverage, rather than the price of export goods, because, of course, manufacturing is a much smaller part of the share of the global economy. And so you think commodity markets were sooner or later going to have to filter from bond markets into equity markets, and we've seen this in quite a disorderly way this week alone.